but I think it's going to be very similar. The news is going to fade away, and we'll see the fear kind of drop as well. Unless obviously a lot more bombs and more things kind of escalate, then oil will hold itself up here. Yeah, well, I mean, I would argue that. I would say stocks were hit pretty hard. The S&P 500 was down 1.75% this morning. And so we just need to see if that is going to happen over the next couple of weeks or not. Until the stock market picks a clear direction, the markets are really just kind of noisy and dangerous and choppy to be involved in.
And it's a big move.
Yeah, well, there's definitely the markets have been really kind of chattering and trying to figure out what to do. The equities market, precious metals, oil has been moving higher for the last several weeks and trying to figure out what's going on. Of course, the news has just, I think, has caused a little bit of a kind of capitulation move. So when we zoom out, well, first let's look at the daily chart here of oil. We saw about 11 or 12% spike in oil in overnight trading with the news. That's initial wave of fear. Everything hits the media and algos and traders instantly panic. And of course, they created a huge move. When we have war, we tend to see gold and oil move higher. And since then, we have been seeing oil kind of pull back quite a bit. It's given back about half of those gains since that news kind of broke free. Now, when we zoom out on the chart of oil and we just kind of go way back in time, you'll notice that the long-term moving average is green 150-day moving average, which is a great gauge of what the long-term trend is doing. The markets really are still kind of making a series of kind of lower highs overall. The trend is down. This is a counter trend rally kind of within a bear market that oil has been in. And we just had this big gap more or less on news just around it. Now, we kind of had a similar scenario over here in terms of bombs being dropped, and it created a huge spike. And so this is what happens in a bear market. You get some of the strongest rallies, and a lot of times they're triggered by some type of news event, and it creates anybody who's short to start to cover. And of course, this is a big event, and it's created another huge pop in price. So the big question is this just a news-driven pop up into and past resistance, and is it going to fade back down? At this point, I kind of think that's what's going to happen, and I think we'll fall back down into this range. But when you look at it short-term wise, definitely a lot of people today are thinking oil is going to go through the roof. But this type of move is typically a capitulation move. We usually see exhaustion, big gaps, big news kind of hit when prices is pushing to an extreme. And we're seeing this today across the board. This is happening in gold and in the equities markets, which we'll touch on shortly. So at this point, oil is, it's the fear has been worked into it. It might want to rally back up, test those highs today or over the next couple of days. But I think it's going to be very similar. The news is going to fade away, and we'll see the fear kind of drop as well. Unless obviously a lot more bombs and more things kind of escalate, then oil will hold itself up here. Yeah, typically when you have a big move, when we zoom out here, when you have a big move above a resistance level, this falling kind of trend line, we have this huge gap. So gaps generally get filled, meaning if a gap's really high, it's usually going to fade back down. As you mentioned, you fade the gap. It's a trade that a lot of people do, aggressive short-term traders. And so when you have a big gap, first of all, they usually fade back down once the momentum stalls. Here we also not only have a huge gap, but it actually gapped above resistance. And it also happened on very big extreme news over the weekend where people can start to panic and build up stories in their head and start to worry. And it creates these huge moves. So typically when you see a big move that happens on news, we tend to expect that market to fade back down to where it was before all of that. So these are usually a short-term trade or a short-term blip on the chart. If the long-term trend is down, this is just one of the spikes, one of those blips that is just volatility within the asset class where news and things like that just trigger these sharp pops and drops in the market.
Crude prices jumped sharply, at one point rising more than 10% in thin overnight trading. Fear of supply constraints, especially if shipping routes near the Persian Gulf are threatened, fueled the rally. However, oil has been in a broader downtrend for months, weighed by slowing global demand and strong U.S. production. Technical traders often view sudden gaps on breaking news as exhaustion moves, sharp surges that fade once emotion cools. Unless infrastructure is directly impaired, markets may retrace part of the spike. The pattern echoes previous geopolitical scares: intense initial buying, followed by reassessment as reality replaces speculation.
Yeah, well, I mean, I would argue that. I would say stocks were hit pretty hard. The S&P 500 was down 1.75% this morning. The Nasdaq took a real beating. It was down over 2% this morning. It was looking really bleak. People were dumping shares. There was panic selling. But just like oil gapped up past resistance on news and gold shot higher on news, now that the markets are opening, all that fear turned into people dumping stocks, which created a huge gap lower, the opposite of oil. And so we're still in an overall kind of bullish environment for the equities market. We are hanging on to a thread with both the S&P 500 and the Nasdaq that if they start to break down from here, it's going to get ugly. But right now, whenever there's a bout of selling or a bout of fear that hits the market, we are seeing buyers step in and accumulate it. We're still in a buy the dip mentality. So these fear-driven spikes are short-term oversold conditions for equities that push right down into a short-term resistance area or support level, and buyers are stepping back up. So everything, either if it's defensive or energy based, it's spiked higher and it's pulling back now. And if it's stock driven, investors were scared, they sold everything, but now they're stepping back in and buying it up, realizing the end of the world's not here right now, and they're buying the dip instead. So we're just seeing this big, this huge volatility swing between risk on, risk off assets of what happens around kind of war scenarios.
When something gaps down intraday by 1.75%, almost 2%, and then moves up immediately after within a span of, hasn't even been 2 hours since market opened, Chris, you and I are talking right now at 11 o'clock. This type of extreme volatility, how do you feel about it as a trader? What kind of mindset does that put you in for the rest of the week?
Well, when you have this type of price action, which we're seeing today, it is a short-term bullish price action. So it's telling us that the market's probably flushed, had a lot of panic selling early in the morning, flushed out the scared traders, the short-term traders who were going to sell on that type of news. And buyers are stepping back in and accumulating it. So this will create a very strong reversal type candle, meaning we could see another 2 or 3 green bars after this. The Russell 2000 is a pretty good gauge of this. It had a very strong gap to the downside. I'm not sure what it was exactly, but we saw, it was about a 1.4%, and it's rallied right back. And the microcap stocks, they had a big gap down this morning as well, down 1.7%. And they have now rallied like 2.6% today. So money is still very aggressive. They're buying up the most kind of the more lucrative, the more speculative stocks on these pullbacks. And that's just telling us we're still in a kind of buy the dip mentality. People are still thinking the markets are going a lot higher. And right now they're shifting into small and micro caps and out of the Magnificent Seven because they don't see the potential with mags. They've been stalled out for too long. And now people want to get into the more aggressive things that can pop and move. So it's a bullish sign. And I would expect another couple of green bars after today before it potentially stalls out.
While energy markets swung violently, U.S. equities proved more resilient. The S&P 500 and Nasdaq 100 opened sharply lower, but quickly recovered losses. This rapid rebound signals a market still conditioned to buy the dip. Investors appear cautious, but not panicked. Defensive sectors briefly outperformed, yet aggressive small-cap names also attracted buyers. The message is clear. Despite geopolitical stress, traders are not yet pricing in a systemic financial shock. However, technical patterns suggest the broader uptrend is fragile. If key support levels fail, volatility could intensify dramatically.
So I would think the markets will want to run somewhere all the way up to, we could very easily see it, the S&P 500 run up to like 600 or 6,945, somewhere up here. There's going to be a bit of a kind of a resistance level, right? A falling trend line. It's making a series of lower highs. It is making a series of lower lows. So price could have another little bounce here of about 1%, which isn't very much. And then it could come back down and test this very critical support level that if eventually it breaks, we could see a big breakdown. So that's kind of the upward resistance, 69.60 area. If we look at the NASDAQ 100, it's kind of a similar scenario in terms of, I think it could come back up somewhere to the upper end of this range. It might want to come right back up into resistance. That's around the 25,500 level. And percentage wise, I don't think it's all that much. It's probably 1.5 or 2%. Yeah. It's about 2% upside. And then we're going to run into resistance from there. Well, believe it or not, we moved to cash already. So we've already seen the NASDAQ break down from a short-term support level. It is already forming a bear flag. Looks like it wants to go lower. We actually moved out of the equities market. I'm pretty bearish on this type of chart pattern. The Magnificent Seven look ugly. The NASDAQ looks ugly. And we've got obviously wars unfolding. So I think we're going to see lower pricing. I think short term we're going to have a bounce. This is a technical oversold bounce of 1 or 2%. But overall, I
trying to capture that. I mean, how short term are we talking about here? Is that shorter than your time horizon usually?
Yeah, like this 1 or 2% move up, that's not something we're looking to take advantage of. We're looking for the markets to break down and to just avoid more or less the equities market as a whole. We don't want to hold it if it's going to the downside. So we're not looking for the upside at all at this point. We're letting the market work itself out. A 1 or 2% move in the NASDAQ back and forth is just noise. It's not something we're looking to trade.
One of the most intriguing developments is the simultaneous rise in gold and the US dollar. Traditionally, these assets move inversely, yet during extreme uncertainty, especially military conflict, both can strengthen as investors seek safety. Gold remains near historic highs, consolidating after a powerful rally fueled by central bank purchases and expectations of eventual Federal Reserve rate cuts. However, technical indicators suggest potential exhaustion near resistance levels. If tensions ease, gold could retrace. But if instability persists, safe haven demand may accelerate. The next decisive breakout or breakdown could define precious metals performance for months ahead.
Yeah, well, there's kind of two methods of trading and investing that everybody uses. Either you have buy and hold or some of your portfolio, which is really passive. Really, you don't do anything, right? You just ride out the market, the volatility, let time kind of heal the corrections and things like that. The other strategy is people become very active and they try to catch these 1 to 2% moves or bigger moves. But active trading is very difficult. And passive investing, you just waste decades worth no returns for many, many years over and over again, and you've got to ride it out. So my philosophy is like, let's focus on some cycles that happen in the market, the waves that roll through the markets 5 to 12 times a year. A lot of trades we get in will last somewhere between 20 days and potentially 2, 3, 4 months. And so we're catching these larger waves and cycles that roll through the markets every year. And that's what we want to catch. And we just want to compound our growth, catch these waves, these new legs to the upside, avoid the market corrections. And I just trade ETFs. So we move in and out of equities, bonds, currency. We do some positions in precious metals like gold. And so we just navigate the markets and we're not trying to actively trade. I would say we're an active investor because we're managing our portfolio. Because I don't believe in holding assets that are falling in value. I don't care how much I love them. If they don't meet the criteria, they carry a lot of risk. I'd much rather step aside, wait for an opportunity to get in. And these markets that we're in right... Sorry, go ahead.
No. I thought you were finished. Please continue.
No, I was just going to say these markets are extremely volatile. And today's news, seeing gold have a huge pop, we're seeing oil have a pop. I mean, we're seeing even currencies. Like if we take a look at the dollar, this is what's really interesting with the scenario that we're in right now is we have this huge 1% rally in the dollar today.
Yeah, I was going to ask about
and
that.
Gold is actually moving higher.
Yeah.
And usually we see the opposite, but we're in this unique scenario. And this clearly tells us that when the stock market crashes and there is global fear, the dollar tends to do well. And so we are seeing the dollar move up substantially, but because it's like also a war scenario here, gold is also broken this relationship and gold is moving up with the dollar. And so the big move up in the dollar today is telling us that overall, I think the stock market is very scared. The momentum has shifted from an uptrend to now it's kind of neutral, which is why we're not involved. We want to be either in an uptrend or take advantage of falling pricing. We don't want to be stuck in a sideways market. And so the dollar's got this huge move up in telling us that there is some global fear and that we need to be aware that there could be a huge leg down coming for equities. And the big question will always be, if we get a move down in equities here, is money going to flow out of stocks and into precious metals? And that's what we saw in 2008 temporarily. And so we just need to see if that is going to happen over the next couple of weeks or not. Until the stock market picks a clear direction, the markets are really just kind of noisy and dangerous and choppy to be involved in.
Bitcoin's rebound added another layer of complexity. After falling sharply in recent weeks, it bounced alongside equities. This behavior reinforces its current identity: less a safe haven, more a high beta risk asset. When stocks recover, Bitcoin often follows. Yet structurally, it remains below key long-term trend indicators. Technical models suggest further downside is possible if broader markets weaken. Institutional flows, ETF participation, and macro liquidity conditions remain critical drivers. For now, Bitcoin appears to be mirroring sentiment shifts in technology stocks rather than behaving like digital gold. Its next move likely hinges on equity market direction.
I think it's found a short-term bottom. It's consolidating through this, what I think is still a bear market pattern. I mean, there's no doubt it could still kind of work itself up and work itself higher, very similar to this here is a bear market pattern. And it could still kind of meander its way higher. But the overall downside target for Bitcoin, it's still in a bear market. The overall long-term trend is down, price is below it. All the other moving averages are sloping down. It's a series of bear flags. And using Fibonacci extension, it shows us where the next major downside target is for Bitcoin. And Bitcoin, if we were to just take a look at this chart, it is around 5,100 is the next level. And as you and I have talked about this before, you have the move down and then you have the bounce back up. And based on that, using Fibonacci extension, when you fall down to this 618 ratio and pause, we almost always see it come down eventually. So again, today we're seeing stocks bounce and get bought up in the dip. And Bitcoin likes to move with that risk on asset. So if small caps and micro caps and the stock market is getting bought up today, Bitcoin is getting the exact same thing. And so we still might see another couple green bars for Bitcoin because I think it's going to follow the stock market. But I do feel like things are going to fizzle out and we're probably going to see it head lower. I'm definitely more bearish, very bearish on Bitcoin because it is in a bear market. It has sold off dramatically. It has bearish price action. Everything is still pointing to lower pricing. It's just found a temporary bottom before I think it goes lower.
Can you just comment on whether or not Bitcoin is basically still moving in lockstep with the stock market then? So your analysis for Bitcoin sounds very similar to what you just said about the stock market.
Yeah, I would say Bitcoin is it's leading the stock market. It's already broken down, right? It's clearly in a bear market. It has broken critical support. I would say like the NASDAQ is kind of like in the S&P 500 are kind of like here, right? It's trying to hold support and Bitcoin is already broken down. So it's definitely leading the way. Money has rotated out of Bitcoin and it's still following the stock market. When there's a big down day in stocks, we pretty much see Bitcoin go down. When there's a big up day in stocks, Bitcoin goes up. But there's a constant stream of selling in Bitcoin, constantly pulling it down. If the NASDAQ doesn't go anywhere, we tend to see Bitcoin naturally just kind of want to fall.
Okay. Chris, let's talk about anything you do like a lot besides what we discussed so far.
I do like a lot. I mean, we have been seeing the bond market come to life. If we take a look at TLT, we have been seeing, I mean, it has been in a big downtrend for a long time. It's trying to build a base. We have been seeing more often than not, we have been seeing bonds move up while the stock market shows some fear. When we see defensive sectors moving up like consumer staples and utilities and even gold, we are seeing the bond market move up as well while stocks fall. And so we're starting to see that relationship again. And it looks like bonds want to kind of build a new kind of launch pad here. It's had a nice little impulse move to the upside. And I think we could eventually see it start to move higher. Now, when we zoom out on the chart of TLT and look at the long-term picture, you can see at best it is going sideways. If not, it's still in a bear market. So it still has some room to really create a new bottom here. And this is going to be a very critical kind of level for TLT around this $91, $92. It needs to break through these highs. And once it can break through those highs, then it'll start to create this rounding formation where it'll start to put in this rounding bottom. And once you break through these resistance levels, I think it'll start to build some launch pads. There will be some other key resistance levels through this chart that it still will have to break through eventually to put in a giant basing formation and get out of this. And like a real level will be back above 100. When it can hold itself back above 100, I think it'll be potentially off to the races. This could be in the equities markets are crashing. Maybe interest rates are getting cut, and we're seeing the bond market move up. But it is slowly showing signs that it's coming to life. And the other play that still looks good is, I mean, we take a look at gold. If we look at gold's chart, it's had a series of moves that are kind of been repeating themselves. We have a rally up and then it consolidates for a while. We have another big rally. It consolidates for a while. We've had this over and over, and usually each time it's around a 20% move. And we've just had another one. And so the big question is, how is gold going to react? A lot of times it takes several months to work through. Usually price comes up and tests near the highs a few times, and then eventually it has a breakout. And so we're kind of back up testing these highs, and we're starting to see, I feel like it's a little exhausted, and gold may pull back and it might build a launch pad to start to break through again. And if it does show signs of a breakout, then it could be very good trade, because the next move for gold based on Fibonacci is telling us around 6,100. So there's some pretty good upside for gold still. But there was a lot of damage done to this chart. And when we look at the chart of gold, this big red bar is something to be worried of. This is a very bearish kind of chart pattern. The body of this red bar, we have all of these bars inside acting as inside bars. This is a bearish price action, and it can mean that once you reach and breach that level, you can have a very big red bar that brings it right back down. And we saw this in silver back in 2011, actually. If we look at the silver chart, down at the bottom, we had this huge red bar, and then you have all these inside bars. It works itself back up, and then it breaks and resolves to the downside. So that's like a visual of kind of how that can play out. And so that's kind of what we're trying to figure out with gold. It's either it needs to put in more time and build more of a launch pad and prove that it's not just going to get rejected here. But I do like gold. If gold builds a nice launch pad and takes some time to recover, hopefully we don't have like more war stuff that just creates it to pop and take off, because I feel like getting up into this range at any point, I think we could actually see another big bout of selling. And if for some reason something in the Middle East seems to kind of get somewhat resolved, or bombs stop getting dropped and things like that, we could very quickly just naturally see the fear dissipate and gold pull back very quickly. So I think gold has quite a bit of risk up at resistance. And because we just had peak news and we're at peak price, I think there's more potential for it to pull back at this point. But over time, I do still like gold if it can build a bull flag and then eventually have a nice breakout.
How are you bullish on silver right now? Let's talk about silver real quick.
Sure. Silver, I'm still pretty bearish on it. There's a lot of damage done to this chart. It's got this massive red bar. These are kind of inside days. We are seeing selling with silver today. We saw a lot of fear in the markets early on, and silver was trading higher, but it's quickly gotten sold into. So I'm not a big fan of silver at this point. I definitely prefer gold because it's more stable, but it also has a much stronger price pattern. And investors go to gold when there's actually, some real fear going on in terms of war and things like that. And that's the scenario we're in. So silver, I think, could sell off and pull back very sharply. I would temporarily still avoid silver. It might be a very good play when gold builds a launch pad. We'll take a look at silver. We'll see how it looks, and it could be a very good play. I think silver has potential to pop to about 140. That would be the next upside target based on technical patterns. So there is potential, but I definitely want to wait for silver to prove that it's built a base, that it is starting to go up, and then I'll jump on that train.
Okay. Chris, let's wrap up now with gold miner stocks. Just take a look at the GDX.
Sure. Yeah. When we take a look at this, the miners have definitely they've already pushed to some highs. They've definitely been leading the way with gold. And there's been a huge talk, in the precious metal space of, gold and silver having, or especially silver, having just so much value added to it so quickly, a lot of people have been, moving from physical and moving into miners. And I think there's been a huge tsunami of investors doing that. And so that's why one of the reasons why I think gold miners have done so well, and silver miners as well, because money's come out of physical silver and it's moving into the miners. And so there's a money flow. And I think that's probably why silver is underperforming, is because people aren't looking to jump into it. I think a lot of people are buying get into the miners, and because the multiples, aren't quite there. Depending how you look at the fundamentals, we should see miners like way, way higher.
Beyond oil, gold, and equities, the bond market may hold critical clues. U.S. Treasury ETFs have begun stabilizing after a prolonged decline, reflecting expectations that economic uncertainty could eventually force rate cuts. Meanwhile, gold mining stocks have outperformed physical silver, benefiting from investor rotation into leveraged plays. Yet miners remain equities, and vulnerable if stock markets roll over. The coming weeks will test whether current volatility is merely a temporary shock or the start of a deeper corrective phase. In markets defined by speed and emotion, discipline, not reaction, remains the most valuable asset.